welcome back everybody. So today we're going to be continuing on with chapter 7. So yeah, today we're going to continue on with chapter 7 dealing with inventories. Last time we left off with purchase obligations. Let's see here. I'm just going to see here because I want to jump into problems here. So what did we cover earlier? Okay, let's just see. Let's just flip through these real quick and see. Product cost, period cost. Okay, so product costs are going to be what goes into determining the product. So that's going to enter into costs that are going to be inventoried. Okay. So that's going to be like your direct labor, your direct materials, your overhead that applies to the product. We went through that a little bit before in class. Your period costs are going to be more of your selling and your general and administrative costs. Okay. Purchase discounts. We can record at either a gross price method or a net price method. Pretty much under the gross, we're just going to just account for the sale at the gross price without factoring in the discount. And then once we collect it, whether they take advantage of the discount or not, is going to determine whether we have to add additional sales revenue or take some away based upon that entry. The net method, obviously, this is where we're going to be recording sales net of the discount, and that's the same thing as the 210, net 30, stuff like that we've talked about. So that's all we're talking about here. Either we're going to record it with the discount or after the discount. I'm pretty sure we've went through some examples of either way we've done it. So purchase discounts we can see there. Okay, cost. Let's talk about the cost flow assumption. So what exactly is a cost flow assumption? It's dealing with when dealing with inventory. So pretty much what it's going to be is just the way that a company assumes the cost of their products, the way that they're flowing, okay, and so it's pretty much the way that they're going to assign the cost of inventory sold or cost of goods sold, and then how they're going to assign a value to their ending inventory, and they just make an assumption in which they think that the flow of goods is going to go. Okay, the major assumptions here we can see are specific identification. This is where if we have like large units, like maybe a grand piano or something, it's a really large value, so we're going to specifically identify that. Okay, so that's just specifically identifying each unit because it's a specific unit or a really high value one, something like that. Next, first in, first out. This is just assuming that the stuff that was purchased early in the period is going to be sold first, and then the goods that we purchased last will be remaining in inventory. The next one being average cost. That's just going to be where we take an average cost of the overall units on hand by the overall price of the units, and then we're going to use that average cost, that unit that we find for the average cost, for both applying it to the cost of goods sold and to that of ending inventory. Last in, first out is the complete opposite of FIFO. That's where the last goods we purchase is going to enter into the cost of goods sold. They're going to be assumed to have been sold first, whereas the ones purchased in the beginning of the period are going to be assumed sold last. So that'll make up the ones in our ending inventory. Okay, so those are the major cost flow assumptions under GAAP. There's no requirement here that the actual cost flow will be related to the actual physical flow of goods. So we might be selling the last ones first, but beyond FIFO. So it doesn't have to match up to be the matched exact flow. That's why it's saying that it's an assumption. The only one that it does actually meet that is specific identification, which makes sense because if we're specifically identifying something, then that's going to match the actual cost flow. So let's see here. We'll get into some problems here. We're going to work through some specific identification. Like I said, that's specifically identifying. I'd rather do our own ones. Weighted average cost per unit. You can see the formula here. Cost of goods available for sale. So that's just overall cost divided by the units available for sale, which is the overall units. Pretty simple. periodic inventory. We know we have, so what's the difference between a periodic inventory system and a perpetual inventory system?
Let's see. Well, the periodic is just in that period. Like, trying to think of an example.
Think of the name periodic. What would we do periodically?
Oh, okay. So periodic is that you take an inventory every so often,
Right.
and then perpetual is inventory is automatically kept.
Right. So that long and short, that's all it is. Perpetual inventory system. Every time we make a sale, then we're going to have to calculate cost of goods sold and relieve our inventory. So every time we make a purchase or a sale on perpetual, it's automatically accounted for. So the amount of inventory on hand should be accurate, and the amount of cost of goods sold is realized every time. Whereas under the periodic one, then we're only just accounting for revenue. So we're not actually doing the second entry, which is the cost of goods sold, credit, merchandise inventory. So that's the difference between the two. And then at the end of the period, we do a physical count, and then we just make an adjusting entry to bring up our records, to adjust cost of goods sold in the records. Good to point out, under both systems, periodic and perpetual, we'd want to do a physical inventory count at the end, just to make sure that for the perpetual one, we would want to do a physical count anyways, just to make sure that the records still match with physical goods, to see if we have any shrinkage or anything like that. So that's pretty much long and short. That's the difference. One, it's constantly being updated, and the other, it's waiting till the end of the period. So those are the two major ones here. Okay. Let's see here. So let's talk about here for just a second. In a period of rising prices, so it says here the FIFO method produces the lowest cost of goods sold under a period of rising prices, and that makes sense, because if under a period of rising prices and we're using FIFO, it'll produce the lowest cost of goods sold. Because think about it, if we're using FIFO, we're assuming the ones we purchased first are being sold first, right? So if the prices are rising, then the products that we purchased near the end are going to be more expensive. So if we're assuming that we sold the products in the beginning with the lower cost, then obviously the cost is going to be less, right? And then ending inventory will be more because they're valued more, higher, right? Does that make sense? Complete opposite with the LIFO, right? So period of rising prices, the cost of goods sold would be more under LIFO, and ending inventory would be less because the beginning ones were purchased at a cheaper price. So does that make sense? Okay, so we went through that. So it says here the average cost amounts are between the FIFO and LIFO extremes, because the ending inventory and the cost of goods sold include an average of both the lower and higher periods. So we can see that. So weighted at, or the average cost rate in between, which makes sense because it's just an average, same units applied to ending inventory and cost of goods sold. These obviously are opposite ends of the spectrum. So one, prices are rising, one's different than the other as far as cost of goods sold, and then vice versa. So it makes sense there. Okay, so let's talk about this one for just a second now. So what are the consequences of using alternative inventory cost flow assumptions? So under income measurement, obviously, that if we use different assumptions, the income measurement is going to be different. It says here for financial reporting, the basic objective of accounting for inventory is to report a relevant and representationally faithful balance sheet value for inventory, and to achieve a proper determination of income through the process of matching appropriate cost against revenue. So once again, here's our matching principle coming back right here. Unfortunately, there's no simple answer as to whether income is better measured under LIFO or FIFO. Both methods match historical costs with revenues, but the major argument in favor of the LIFO is that it matches the most recent cost with revenue. Okay, so LIFO matches the most recent cost with revenue, which makes sense. The most recent costs are closer to the replacement costs and the cost the company will have to incur to replace the inventory that was sold. Income tax effect: the use of LIFO for computing taxable income may result in lower payments for income taxes. This makes sense because we know income tax is based upon your income. The higher your income, the more that bigger a tax liability that we're going to have. So obviously, the normal flow of prices is to increase through inflation. So as times go on, usually prices and products go up, right? So obviously, if we're using LIFO, it's going to reduce our gross profit, so it's going to reduce our income tax liability. So that's why we can see here that LIFO will have a good effect on income taxes. So a lot of firms will use LIFO for income tax purposes. So it says here, the Internal Revenue Code permits a company to use LIFO for income tax purposes only if it also uses LIFO in its financial statements. Okay, so this is known as a LIFO conformity rule. So they can use it for tax purposes if it also uses it for financial statement purposes. Because remember, companies have two different sets of books. They have one for tax purposes and one for financial accounting purposes. So they're saying you have to use them with both sets here. Okay, liquidation of LIFO layers. So a company using the LIFO method may experience a decline in inventory during a period when the units of sale of inventory are more than the units acquired. Therefore, some of the beginning inventory costs are included in cost of goods sold, producing increased income. So in a period of rising prices, these older costs are lower than current costs. So this increased amount of income is often referred to as LIFO liquidation profit, okay? So it's pretty much just assuming as periods rise, like I said, difference between purchasing and selling, there's going to be a difference that we have to liquidate previous layers, okay? Once again, it's known as the LIFO liquidation profit. Example, liquidation of LIFO layers. Let's say here, Val Company was formed in 2015 and uses the LIFO cost flow assumption. Its 2019 beginning inventory of 644 is made up of 4 layers as follows. So here's the inventory on January 1. It said it was 644. We can see the total. We can see the year's layers. 10,000 units at $20 a unit, and so on and so forth to make up the total inventory. Okay, so in 2019, Val purchases or manufactures 50,000 units at $35 per unit, but sells 60,000 units. Okay, so we can see the difference between the amount that we manufactured and the amount we sold. Okay, so we're going to have to dip back into an older period to get those other 10,000 units. Val has an inventory liquidation of 10,000 units. Val's cost of goods sold for 2019 includes costs from 2019, 2018, and 2017 as follows. Okay. So the first thing we want to do is the 50,000 units right here at 35. So we've got the 1.75 here. These are our 19 costs, right? Because in 2019, that's what they did, purchase or manufacture those 50 units. So there's that cost. Next, we need the 4,000 units at 30. These are the 2018 costs. 4,000 units at 30, right? So we need to make up those units as well. Then we're going to need to take 6,000 units from the 2017 ones right here, okay? And that'll make up the total 60,000 units that we sold. The 50 from the current period, and we had to dip back into the old periods. If you notice, there's only 4,000 left from 18. That's why we had to get an additional 6 out of this. So there's still 2 units left over. So ending inventory would be 10, 6, 2. You seeing that? Okay. So then there would be our cost right there. All right, not bad. So just LIFO liquidation. If we sell more than what we produce or purchase, then we have to dip back into an old layer and get it at that cost. So not bad, right? Earnings management, we can get into that. Okay. So just talking about an earnings management a little bit. Talking here, earnings management, obviously LIFO, then it can be used as tax advantages, and obviously depending on which cost flow assumption you can use, all three different cost flow assumptions, whether you're using LIFO, FIFO, weighted average, whatever they might be, produces a different cost of goods sold, different gross profit. So you can see how that you could use earnings management as far as based upon these cost flow assumptions. Okay, so that's a long and short on that. So inventory valuation, let's see here. During periods of rising cost, the LIFO method produces a lower inventory value on a company's balance sheet because the oldest remains in this inventory. A financial statement user evaluating a company that uses LIFO will generally convert the inventory to non-LIFO or FIFO amounts to enhance comparability. So companies can use whichever one they choose to. As far as tax purposes, IRS and GAAP allow them to choose whichever one they want. There are many factors that influence management selection of an inventory cost flow assumption: physical flow of goods, conceptual issues, tax considerations, bookkeeping and other related costs, stock price effects, and contracting considerations. There's just little real disclosure of inventory values here. No questions tied to it. Okay, so what is the dollar value LIFO method? That's kind of what we were just getting into with the layers right there. So it follows the same cost flow assumption as the LIFO method, but it overcomes 3 difficulties involved in applying the simple LIFO approach. Record keeping. The LIFO method requires a company to keep numerous detailed records of the physical quantities of each item in its inventory and apply unit cost in the LIFO order. So we saw that from the order, how we could see each layer with each year. So that's the record keeping. The LIFO liquidations. So this fluctuations in the physical quantities of similar inventory items may occur during a period, causing a partial liquidation of its LIFO layer that would remove many of the advantages of LIFO. So we can see here that we saw when we removed the layers moving up. Technology change. As technological changes take place, inventory made with one material is replaced by inventory made with a substitute material, or an outdated design is replaced by a newer design. So strict application of the LIFO method would require a company to start a new LIFO base for the new inventory item, and as the old item is phased out, to reduce its inventory to 0. So once again, as we phase those items out, we would want to replace them with the newer ones, is all it's saying. So this would obviously eliminate the advantages of LIFO built up in previous periods, okay? Because we'd have to be replacing the older units with the newer ones that are now available. Okay, cost index. So let's talk about this real quick. We're dealing with the dollar value LIFO. So the cost index just refers to an internally generated index that relates the current year cost of inventory to the base year cost. So remember, we have a base year at the original up at the top, and we had all those original, that problem with all the different years of inventory. So the base years will be the original with the base year index, okay? So we want to always just refer the current years to the base years, okay? There's the 2 methods. So the first one here is the double extension method. So a sample of the ending inventory is priced at current year cost and at base year cost. And then the cost index that used to calculate it is right here. So the cost index is the ending inventory at current year cost, okay, divided by the ending inventory at base year cost, all right, times $100, or times 100, okay. And we can see that makes sense why it would be called the double extension method. So say if we're in year 10 and we have the ending inventory at year 10, we're going to extend it all the way back to the base year cost. So that's the double extension method, okay? Next, the linked chain method. The ratio of the current year current cost to the previous year cost is used to compute the cost index, okay? So once again, this index is multiplied by the cost index carried forward from the previous year to determine the current year cumulative index as follows. So ending inventory at the current year, right? So the numerator is the same. Denominator is the ending inventory at the previous year. So we can say here linked chain, because you know a linked chain is one piece connected to the other. So we can see the linked chain just uses the previous, whereas a double extension method uses the ending year's value by the beginning, the first period, right, times 100%. This one is ending times the previous linked chain times previous year cost index, okay? So whatever the previous year's cost index was is what we base this off of instead of 100, okay? So it makes sense? So double decline, or the double extension is the current year by the first year times 100, and then the linked chain is the current year divided by the previous year times the previous year's percentage, okay? Inventory pools. So pretty much what all it's saying here is we can just group similar or like items into inventory pools and apply the cost flow assumption to that pool. Okay, that's pretty much long and short of what that's saying. It says, so companies apply the dollar value LIFO to inventory pools by grouping inventory items that are similar as to types of material or use. Purpose of the inventory pools is maintain the benefits from using LIFO when fluctuations in the physical quantities of similar inventory items occur and when technological change takes place. So when the quantity of one item in the inventory pool is reduced, the reduction may be offset with an increase in the quantity of another item in the pool. So it's just one's gain or loss offsets the other. So therefore, the liquidation of LIFO layers and the loss of the tax benefits of LIFO are normally avoided. Okay. Let's see down here. So let's just talk about this a little bit more. So it says application of the dollar value LIFO for the first part. The general principle of the dollar value LIFO method is that a company is trying to separate the change in the physical quantity of inventory from the change in cost of the inventory. Okay. A comparison of the year's beginning and ending inventory pools at base year cost indicates whether there has been a real increase or decrease in the physical quantity of the inventory. The company then rolls forward the increase or decrease in the physical quantity to the appropriate current cost level and adds this layer of current cost, or subtracts it from the beginning inventory to determine its ending inventory. Okay. We went through this. So step one, value the total ending inventory at current year cost. We know that's the first step. Step two, convert or roll back the ending inventory cost to the base year cost by applying the appropriate cost index. So remember, that's the index, either the double extension or the linked chain, right? So we find the ending inventory, then we do that by whatever the index we use. And then step three is compute the base year change in inventory level by comparing the ending inventory at base year cost with the beginning inventory at base year cost. Step four, if there's an increase in the inventory level at base year cost, then there has been a real increase in the physical quantity of the inventory for the year. And if there's a decrease in the inventory level at base year cost, there's been a real decrease in the physical quantity of the inventory for the year. Okay, so let's see. I don't want to get into that one right there, but there's another problem. Okay, so obviously companies have to disclose what method of what cost flow assumption they're using in their notes. So this is one of the required disclosures for GASB, or for FASB, I'm sorry. So the following information we would expect to see: the composition and carrying value of the inventory, so the raw materials, work in process, or finished goods. Any accounting policies, including the cost flow assumptions. Any inventory financing arrangements, so including unconditional purchase obligations, and then LIFO related disclosures, including any of the effects of the LIFO liquidations and any LIFO valuation allowances. Okay. Here's just an excerpt right here of all the disclosures that a company would make, just a little snapshot. And here's the comparative purposes here with just the composition of the inventories, raw materials and packaging, finished goods, grain, excessive FIFO or weighted average cost over LIFO cost, and then total. So we can see here that's the composition and stuff, how it says during the notes. Don't need that. Okay, so let's talk about the LIFO valuation allowance, or the LIFO reserve. Because the use of LIFO reduces the comparability between companies using LIFO and those using FIFO, which is going to be an approximation of the current cost, then the SEC requires a company that uses LIFO to disclose the amount of the LIFO valuation. Okay, this difference has a variety of names, including LIFO valuation allowance or LIFO reserve. This disclosure can increase comparability by adjusting inventory, cost of goods sold, and income to a FIFO basis. Okay. So if a company uses LIFO for an annual reporting purposes, it must also use LIFO for interim or quarterly reporting. Okay. If a company uses LIFO and experiences a LIFO liquidation at an interim date, and forecasts indicate that the LIFO liquidation will still exist at the end of the year, the company should include the effects of the LIFO liquidation in its interim financial statements. If a company forecasts that the inventory quantity will be replaced so that there is no LIFO liquidation by the end of the annual period. GAAP states that the company should not include the LIFO liquidation in its inventory valuation, and its cost of goods sold should include the expected cost of replacement of the liquidated LIFO inventory. Okay, so pretty much long and short, this LIFO reserve pretty much is just for comparative purposes, so we can just flip it to what it would be on FIFO. Okay, so that's it on chapter 7 notes here, or PowerPoint. Next thing I want to do is get into working a little bit of some problems out. So apologize, I'll be right back. Let me just go. So there's that. Let's see here. So let's talk about this first one here. See everything right here, okay. So it says at December 31st, 2020, Jefferson Incorporated had inventory on hand amounting to $270,000. So the following items were not included in this inventory. So goods sold and still in transit shipped December 29th, FOB destination, sales price of $12,000, freight cost of $500. Okay, goods held by Johnson on consignment from Miller Company, sales price $12,500, shipping cost $300. Goods returned by customers and held pending inspection cost $1,100. On January 1, 2021, a monthly freight bill for $1,600 was received. The bill specifically related to the merchandise purchased in December 2020, 40% of which was sold in December. No related adjustment had been made yet. Jefferson sells at a gross profit of 25% on account. So what they want us to do is compute the cost of ending inventory to be reported on Jefferson's December 31st, 2020 balance sheet, okay? So it's saying here, at December 31st, 2020, they had an inventory on hand amounting to $270,000, okay? Now, of this $270,000, the following items right here were not included in this inventory, okay? So pretty much what it's asking is, should we add this or just leave it out? So as of right now, with it, this $270,000, none of these items were included in it, okay? So now we want to go step by step and determine if these items are going to be in here, okay? So goods sold and still in transit shipped December 29th, FOB destination, sales price $12,000, freight cost $500. What should we do with this first item right here? So it was goods sold, right? And still in transit. So we sold, that means Jefferson sold it, right? And it's still in transit. And it was shipped December 29th, FOB destination. So so if we sold it, we know we sold this, right? So goods sold and still in transit, shipped December 29th, FOB destination. Sales price $12,000, freight cost $500. What do we need to do with this? Okay, first of all, FOB destination. So whose inventory is it?
It's ours.
It's ours, right? Because we're the seller and it's FOB destination. So we sold it until it gets to the destination, right? It's still in transit, right, at year end. So if we sold it and it's still in transit, shipped FOB destination, then we need to include that in our inventory, right? So it's saying here it's not included. So we need to include this inventory in our ending inventory, right? All right. So what amount should we keep in there? Remember that we want to look at the 25% sales at a gross profit of 25% on cost. So how would we go about getting our cost of inventory? Because right now this is our sales price, right? So now we have to take out that 25% markup. How would we do that? The percentage markup is 25%, right? So watch, here's how we'll do that. We'll take the sales price, okay, and divide it by 1.25, okay? So just to take the sales price is going to be your numerator. The denominator is 1 plus the markup, okay? So it's just going to be 12,000 divided by 1.25, okay? And that'll give us $9,600, okay? So does that make sense? So $9,600 is our cost, right? So the first thing I will do, let me get a pen here. So for number one, the first step of this right here, the goods sold in transit, FOB destination, it's our goods. Selling price is this. Here's our gross profit. So we want to take the 12,000, divide that number by 1.25 because it's going to be divided by 1 plus the markup, right? So divided by 1.25, and I'm pretty sure that gives us $9,600, okay? So we know we're going to have to add $9,600 to this amount right here already, okay? Okay, let's look at the next one. Goods held by Johnson on consignment from Miller Company at a sales price of $12,500, shipping cost of $300. What do we do? What do we do with this one right here? Goods held by Johnson. So now Johnson, goods held by Johnson, okay?
Yeah, I don't know if that's a typo or.
I think it should be Jefferson, not Johnson, because I think you're right, because that's good held by Johnson. I see the same thing. So goods held by Jefferson. Let's say Jefferson on consignment from Miller. So what do we do with that one?
I would imagine that we subtract out the inventory from that because it's not our inventory.
It's not ours, but we don't have to subtract it because remember the way the wording of the question is, you're right, it's not included. So the overall, you're right on what to do with it. It's not included, but just that's where we have to pay attention because of this amount, these items were not included. So it's just good as is, right? But you're right, we omit it, right? So that they were correct on that one. They should have added this one because it was ours. This one here, we're holding it on consignment. They're not our inventory, right? So nothing to do with that. We were right with that. Goods returned by customers and held pending inspection cost of $1,100.
I guess it's our inventory again since it's been returned to us. Do we have that back?
We would, but we're still pending inspection, okay? So once we inspect it, so right now it's just kind of in a holding point. So right now that's correctly accounted, not being emitted because we still have to inspect the inventory before we put it back in inventory, okay? Let's see. So on January 1, 2020, a monthly freight bill for $1,600 was received. The bill specifically related to the merchandise purchased on December 2020, or in December of 2020, was a 40% of which was sold in December. No related adjustment had yet been made. So once again, a monthly freight bill for $1,600 was received. The bill specifically related to merchandise purchased in December. 40% of which was sold in December. No related adjustments have yet been made. So what are we going to want to do here? So monthly freight bill for $1,600. So that'll be our starting point, right? So $1,600, and then we want to back out the 40% of the $1,600, okay? Because that's the amount that it says of which was sold in December, right? So if it was sold, we need to back that out because it's no longer on hand, right? So that's just going to be 1,600. Sorry. Okay, and then we're going to back out 0.4 times 1,600 because that's the units that we sold, right? Okay, and that will equal 1,100, I believe. Okay, so the cost of the ending inventory based upon all this amount here, we know the beginning was 270, right? And then we want to add the 9,600 right here. Then add the 1,100, right, that we found right here. And then I feel like so you know what, Will? I'm sorry, I told you wrong. You were right. Forget the way I told you about the inspection. You're right. We need to add the 1,100 back in. Something wasn't adding up here when I was thinking about it. So you're right. Goods returned by customers and held pending inspection. So they've already been returned. So the customers returned. So we have to include that back in. And right here it is the cost. So I was wondering, man, I'm off by 1,100. That's it though. Okay. So you're right. So once again, we'll go through. We'll just run through it one more time to make sure we're good on this one. That we'll wrap the day up with this right here. So once again, we had 270 on hand, right? None of these items were included. The first one we want to include it because it was shipped FOB destination. It's still ours, right? But it was included at a sales price. So there we just take it back out to 25%. We just do the 12,000 divided by 1.25, right? That'll give us that. The next that gets held up by Jefferson on consignment, that's not ours, so that's fine. We omitted that. Goods returned by customers and held pending inspection. So the 1,100, we do add that back in. You're right. The inspection does not matter. The customers have already returned it, so I apologize about that. And then the freight bill here, remember we received it for $1,600. It was all related to December purchases, but 40% of which of these were sold. So that's where we take again here the 1,600 minus the 0.4 times 1,600 because that's the amount that was sold, and that's the amount left over, right? And honestly, that's 960. That's not even right. That's 960 here. So either way, this amount's added. This amount's added. This is omitted. It just correct as is, and this just takes the amount that was not sold, right? To add to it to the ending inventory would be a total of $281,660. So sorry I chopped that up. But you get this type of problem right here. It's going to tell you what they have in inventory, tell you some transaction data. And then from that point forward is where we just have to determine whether we include the item or do not include the item to get what should be the real amount reported. Okay, makes sense? Okay, so that's it for today. On Wednesday we'll go through. You can see we got some other practice problems here. So Wednesday we'll work through these practice problems. They're up here on the screen, and hopefully that'll get us through chapter 7 here on inventories. So once again, that's all I have for us today. We'll pick back up on Wednesday, working through our problems. Be on the lookout. I will get the chapter 7 homework and quiz posted today. I'll make sure we have enough time to get that in. So I'll definitely get that posted today. So everyone be on the lookout for that, and I will see everyone on